is going to be showing you some of the tips and tricks of how I personally navigate options markets, how I decide whether or not a security is liquid enough for me to trade it. It's not going to be an absolute ironclad rule book. We're retail investors and we get to make our own personal decisions as to what is appropriate for us, especially depending on the size that you're going to be trading. But that is kind of my thought. There's really not any slides in today's presentation, so it's all going to be demo. It's all going to be looking at the real world market dynamics and sort of scavenging around to see what we can find as trading and investing opportunities. Nick, how you doing? We did the morning market briefing together. How are you holding up?
Holding up real well today, Constantine. It's been a lot better than last week, insofar as we had some storms and weather come through the Texas area and lost power a couple of times. And I think the week before, where similar storms were going through Jacksonville, and you guys lost power as well.
Yeah, Nick, Mother Nature um, is certainly not happy. It doesn't seem like it is for sure. I got to catch Storm Debbie down here in Florida and then flew north, and she caught up with us. So I got to weather Debbie twice. All right, without further ado, folks, I have an Excel file in front of everyone. And the reason why I wanted to bring this to your attention is because this is something that you would like to take a screenshot of right now. You would want to bookmark this particular web address. It's going to be directing you to the Chicago Boards of Options Exchange official website. It's not a Fidelity source. However, it is about as credible as they get, right? Take a screenshot of this particular web address, and if you plot or copy paste this web address into your browser, what's going to happen is that it will automatically download the Excel spreadsheet or the Excel file that I'm sharing with you right now. Each and every time that you hit that browser link, it will download the most up-to-date version of that particular list. And you can see that I personally downloaded this list a little bit earlier today. So August 12th, 2024 at 13:06:09 Eastern Standard Time. So a little past 1 o'clock Eastern Standard Time. So what does this list provide for us? Well, first of all, there's a lot of information that is unique and interesting, but there are a couple of highlighted areas that I am showcasing for everybody. First of all, this list is almost 5,000 lines deep. And so what that means is that there are close to 5,000 underlyings that you can currently trade options on in the United States of America, right? These include all of the securities that are single stocks. It includes all of the ETP products out there, exchange traded funds, exchange traded notes, exchange traded products, inclusive of all of the cash settled European style indices. Okay, so everything that you can think of that you can trade options on is on this list. And it also, the information that is pertinent that it provides for us is, of course, the symbol, the name of that particular underlying, who is the designated market maker in that particular underlying. It could be a circumstance where there's a designated market maker, might be a couple designated market makers even. But the more interesting stuff to me is this column I here. The column I is going to be telling me whether or not that security participates in the penny pilot program, or what is known as the penny pilot program at the CBOE, or it doesn't. If it does participate in the penny pilot program, it will say penny in the tick type. If it doesn't, then it will say nickel. That is a very key consideration in thinking about liquidity in markets. Why is that, folks? Well, not everything trades in pennies. And if we think about the cost or the barrier to entry in the options world, what are the actual costs? Are they commissions? Are there commissions? Sure. You're paying 65 cents per contract for execution to Fidelity. There might be some additional options regulatory fees, or in the industry, they're known as ORF fees, options regulatory fees on top of that. But they're usually tiny, right? So unless you're doing huge size in 100 matter the most to an options trader is the liquidity of the underlying security in and of itself. Now, would I say that IVV trading 2 million shares a day today, and on average trading 5.1 million shares versus VOO trading 2.5 million with an average of just shy of 7 million is illiquid? That's nonsense, right? If I was trading under the underlying security and I wanted to buy 100 shares of VOO or sell short 100 shares of IVV, I could easily do it with extraordinary efficiency, right? Trades in pennies. There's plenty of size on the bid offer. And unless I'm trading humongous size, which I don't assume that anyone in the audience does, regardless of your account size, you can very efficiently buy and sell IVV and VOO. The most efficient market out of these three, though, when it comes to the underlying, even though it is substantially more expensive to own in expense ratio terms, is the spider, right? SPY has traded so far 26.5 million shares, and it traded more than tenfold, or trades more than tenfold on a 2-week average basis, what the remaining two are doing. Now, by the raise of hand, which one do you think out of these three products is going to be the most liquid when it comes to options? Hey, folks, the answer, right, should be quite obvious. So when you're trading exchange traded products, figuring out what it is that you're trying to um, exhibit an opinion on, finding a proxy, right, for that underlying security is going to be key. It's going to be important. Finding the proxy and then coming down and saying, okay, is there only one proxy or are there several? If there are several, then you are doing the more in-depth analysis and saying, which is going to be my weapon of choice? Because now I have to dig into the options world and see which underlying has the best options liquidity. Okay. So let's pop over here to the options chain, and I'll continue on explaining kind of my process of thinking. First of all, we pull up an options chain, and before anything is displayed, what I would like you to focus on is the availability of expirations at the top of the board. The more liquid the underlying is going to be, the more, what is liquidity essentially? A lot of market participants engaging, demanding to buy shares, offering to sell shares, right? Lots of bids and offers when people and market participants are trying to constantly evaluate the worth of that underlying security in the open market. The more liquid something is going to be, the more market participants there are in the underlying, the more market participants are very likely to be out there in the options market, given that it is a derivative product. The more interest in the options market, the more calendar availability. VOO, as you can see, has weekly options on it, as well as the monthlies, as well as the leaps. Long-term equity anticipation securities, monthly contracts on the board, and weekly options. Let's switch over to IVV. IVV is going to be slightly different, right? So all of a sudden, we have availability of the weeklies, We have availability of the monthlies, but we get some extra availability for longer duration contracts out there into the future, right? Versus something that we saw with VOO. Now let's go ahead and switch over to SPY. This one is going to be littered with expirations. Not only that it has the expanded weeklies, not only that it has monthlies, not only that it has quarterlies, not only that it has leap contracts, but it also has daily expirations. Again, which ones do you think are going to be the most liquid ones to trade, right? So this is kind of the process of elimination, if you will. So what I'm going to first do is I'm going to go out here to the October monthly expiration cycle. I'm going to purposefully go out a little bit further in time and illustrate a couple of things for you. How many contracts are traded in terms of volume and how many contracts are available in open interest is going to be important, right? However, that could be kind of a deceiving metric, right? You would be thinking, well, if a lot of volume trades or a lot of volume traded or a lot is kind of displayed on the open interest front, that means that contract is liquid. And it couldn't be further from the truth. Sure, it is it's a parallel, right? That you could draw to say the more activity is in something, the more liquid it will likely to be. Or the more activity there has been in something, the more uh, open contracts of calls and puts are on the books, right? Currently, that haven't been closed out, the more liquid that particular strike or expiration could potentially be. However, at the end of the day, you're not dealing with something that transpired in the past. What you're dealing with is the current real
Yes.
world situation. What is the bid ask? How tight is the bid ask? Does it trade in pennies or does it not? Does it trade in nickels or does it trade in dimes? Now, SPY is an interesting example because SPY is an exception to the rule. Not only that it trades in pennies below $3 in premium, but it trades in pennies across the board. Meaning, no matter what the strike and no matter what the premium, it trades in pennies across the board. That is not going to be the case, obviously, for some of these other products, right? So I'm going to switch over and not belabor this point too much on this point too much, but I'll switch over to VOO. And if the spreads on the bid offer spreads on in the money and at the money and out of the money options in SPY were a couple pennies wide, right? 2, 3, 4, 5 cents between bid offer. What are the spreads looking like in VOO? Well, they're pretty awful, right? 50 cents at best. But in most cases, especially on in the money options, they get
Couple of dollars.
substantially wider.
Also
You
different
switch over to something
strikes
like
too.
IVV. Nick, go ahead.
Also that they're different strikes as well. SPY has those every single dollar strikes where VO then goes back to the typical every $5 strikes. So a lot less choice from a strike perspective, in addition to less choice across the expiration perspective.
Yeah, Nick, very good point, right? I mean, SPY is best. So, Nick, now that we've bored everybody, and we've belabored on this point, uh, to the nth degree, the common question that's being asked is, does there have to be open interest? And does there have to be substantial volume in order for something to be liquid? And one thing that I would point out is that it helps, but it doesn't mean that's an end all be all. Why? Because every single day, as the daily expiration expires in SPY, as an example, or every Friday when the weekly expiration expires, time, those options that just got added to the chain, they will have zero volume and zero open interest, but they will still have very tight bid offer spreads. Okay, so it's truly about how wide the bid ask is. The tighter, the better, especially if you're doing size. What I would argue for, folks, and this is going to be, to your own personal preference. This is the way my Active Trader Pro is set up. What I like to do is if I'm trading a single leg option, I like to trade it through a directed trade ticket. If I'm trading a multi-leg option, I'm going to be trading it through a multi-trade ticket, right? I'm going to be trading it through very likely trade and chain type mechanic, or I'll build it out in a profit and loss calculator. But I like to switch my default ticket for single legs of options and stocks, by the way, to the directed trade ticket window. Why is that? Well, if I am trading a single leg, what I want to know is not only what the offer is or what the bid is, depending on whether I'm a buyer or a seller, but I want to know how many contracts are available on either side, right? So I want to see the depth of book. You can see that in SPY, there's huge size on both ends, right? If you're a one lot trader, you don't really care about this stuff. But if you trade 5, 10, 15, 20, 50, 100, then it becomes more and more important. How many can I buy on the ask with a limit order or in between? If I throw in my order in between the bid ask, right? Who am I competing with? Am I competing with a market maker quote, or am I competing with a one lot, two lot, three lot trader that is out there just sitting at a limit, displaying on the bid, and the market maker not willing to fill them and not willing to match their bid and offer in size? Okay. So the more liquid, the more that this little picture looks like a moving screen, the greater the reality of the fact that they're constantly reevaluated bid offers right out there. You pull up something like this, for VOO, and you're gonna have a tough time in there, right? I mean, it doesn't mean that it's a non-tradable product. Of course it is. So it's trading right now at 489. We're gonna look at, like, let's say 490 bid offers. Is this thing tradable? Sure. But who knows what this option is really worth, right? Like, in order for me to find out what this option is worth, I got to throw in a bid out there. I got to throw out an offer. Why? Because the bid offer spread is 50 cents wide. That's $50 for every single contract. So if I just place the market order, I'll be guaranteed $12.70, right? For at least, 40 contracts. But if I had to turn around and sell it right away, I'm only guaranteed 12.20. That's a massive spread. So if I wanted to interact with this marketplace, I would have to place a limit order, very likely somewhere in between the bid ask, and find out what the liquidity truly is like, right? Whether or not the market maker is going to be willing to come halfway and meet me and provide an execution. Nick, I've been talking for quite some time. Wanted to pause here and yield the mic over to you, sir. I know, again, want you to provide your thoughts as well. We'll likely look at some of the scanners that are available in Infidelity.com that I've personally created, and I'll gladly share, kind of my tips and tricks with you, so you can take some screenshots and create similar things.
Before we jump into the scanners, there are a couple other tips to scan for that I'd like to explain to everyone. And this then also does build around, when you're looking at IVV versus VOO versus SPY, other very popular products with that could also be on the index itself, SPX. But then again, SPX trades at 10 times the value of SPY. But there's also XSP, which is the mini, which then trades more in line with SPY, but again, isn't as liquid and
Nick, go
such.
ahead. Go ahead and show them, sir. So if you're talking through these things, show them.
Absolutely. Sorry, I was going to shift over to another example, but let me go ahead and pull that up first. And I'm going to maximize this option chain right here. And I've hidden the weeklies, but you can see SPX does also have the daily option contracts. I'm on the same October contracts that Constantine was on. But since this is an index, we also have these AM settled in addition to the PM settled options. And you can see, well, the underlying is at 5,300 versus 530. And so as such, it's moved the decimal over one spot. Now that said, these are still fairly reasonably tight because even though this is a dollar wide, think of it moving a decimal over $16.70 by 1680. It's only 10 cents wide. Still not quite as tight as SPY being 1 or 2 pennies wide at this same value, but competitive when you're looking at IBV or VOO. .XSP is the mini SPX launched to really kind of compete with something like SPY, with it being the 10th of the value, but still offer the benefits of what are called 1256 contracts. And we can see this also does price in pennies as well, part of that expanded penny pilot program. But from a bid ask perspective, we're still looking at 60 cents wide. It's not quite as liquid as SPY. SPY is some of the most liquid equity options out there. Now, what I wanted to show everyone, Constantine, was building upon volume from an options perspective as a judge of liquidity. Because as we start to get into scanners, this is something I like to add to some of the scanners I do when I'm looking for ideas to find something that's reasonably liquid. And as an example, I like to start with security A, security B, security C, just going alphabetically purely as an example. The option statistics page, the most useful information on this, of course, is the very top. But what can be useful from a screening perspective is the 90-day average volume across all expirations, all strike prices. We see security A has 762, security B has 18 contracts, and security C over 100,000 contracts. Now, to give comparison, Apple, that Constantine pulled up earlier, has almost 1 million contracts on average. SPY has over 7 million contracts on average from a volume perspective. But stepping back with this, we could make assumptions that likely security A is going to be more liquid than B, and security C will be more liquid than both. As we shift over and I actually pull up the option chain on security A, we can see there's no W for weeklies. This doesn't offer weekly options, but we do have those leap options, just like what Constantine was saying and showing the difference between VOO, IVV, and SPY. As we then shift over to security B, and notice here on the October, this is every $5, and this is still about 20 cents wide. And as we get down to $3 not participating in the penny pilot program. Security B, we no longer have those leap contracts, still no weeklies. Looking at September, over $40 a strike, we're going every $5 versus even every dollar. And still, even the at the money, a little bit wider than what security A was. As we shift over to security C, well, now we see weekly options here in addition to the monthlies. And we have a lot more choice. We have more strikes, and we're at 1 penny wide on the September's, 2 pennies wide on the October's, a lot tighter bid and ask spread. And so I like to show this, Constantine, as a little bit of a gauge that when you are looking for ideas, when you're screening for stocks, one thing many traders will look at is they won't consider a company that has less than 20,000 contracts on average. Some traders will look at minimum 5, some minimum 20, some maybe even minimum 100,000 because of that liquidity issue. And yes, like Constantine was mentioning with IVV and VOO, you could float a limit order out there, and you're either going to fill at your limit or not. But what if your exit criteria has occurred and you need to get out? Well, you could be stuck at the mercy of wherever the market makers are, trying to then fill a limit order and having a much wider bid-ask spread. Like we mentioned before, with options, pennies are dollars. And a 10-cent wide bid-ask spread is a $10 difference between where you're buying and where you're selling. 50 cents, $50 difference versus, 1 or 2 cent difference is $1 or $2 over the 100 con multiplier and such as you're trading can really add up to a big cost. And that bid-ask spread will dwarf that 65 cents per contract that Fidelity might charge, or that you might pay in those exchange fees, so to speak. I just wanted to add that, Constantine, before you started to dive deeper into your screener. I felt this was a little bit of good groundwork that we could do going forward.
Yeah, Nick, the reason why this matters, I mean, markets are quite calm right now. Yes, we're not trading at brand new highs, as we were maybe a couple weeks ago, but the markets have substantially calmed down. Folks, when we talk about liquidity and the importance of liquidity, if the reason I think why this is a huge deal and why as a trader, especially if you're going to be actively participating, actively trading, getting in with a risk tolerance, risk management strategy in place, with a profit-taking outlook strategy in place. If you're going to be adjusting, meaning rolling up, down, out in time, if you're participating in the market more than once and you're doing that in size, you're going to be facing this every single time, right? If something is not liquid, let's say you own a bunch of VOO or you own a bunch of IVV and you want to do covered calls. If you're in the in that type of a situation, you're saying, I'm just going to sell the covered call, like no matter what happens. All right. Stock goes down. I'm going to hold it no matter what. Stock goes up. It goes through the short strike that I sold. I'm going to sell the shares no matter what. If you're only interacting with the market once in a month or a quarter, you probably care a lot less, right, about the liquidity factor. But if you're constantly interacting with this marketplace, then these bid offer spreads truly start eating away at your profitability potential. It becomes a barrier to profitability, right? More importantly, if you are starting to participate in the market and when does it matter more? When you place the trade and you ended up being right? Or when you place the trade and you ended up being wrong and you have to get out of that position, you have to manage risk? It's the latter rather than the former, right? If it's the former, at least you're getting out at a profit. So you could say, well, I could have made a little bit more, but I'm making money. Doesn't hurt as bad. But when you're wrong, you paid the piper to get in, you sacrificed liquidity, so you paid very likely more than what you should have. And then the position goes against you. And now all of a sudden you're faced with pain because it moved against you and you are on the defensive. And now you're dealing with that again. So it worsens the losses. Kind of a double whammy, right? And Nick, as traders, we have to assume that we're going to be making a lot of mistakes, right? We're not going to be always 100% correct. And most of the time, people who make mistakes, they manage risk and they make adjustments. So they're
Yeah,
active, right? Depending on the circumstance. So I just wanted to
yeah.
bring that to everyone's attention. Nick is displaying Starbucks, and I think there was a good question here from someone. Christopher, shout out to you saying, Starbucks has an ex-dividend date coming up this week. Can this play a role in liquidity? Does it matter? And Christopher, I think you're onto something here. It certainly does. But what you want to remember, you might want to jot this down. Anytime that there's a substantial dividend that a company pays, substantial meaning in yield terms or cents or dollars relative to the value of that stock price per share. If there is a substantial dividend, what's going to happen is that puts are going to trade rich to calls because the market is not oblivious to the fact that this company has declared officially an ex-dividend date with a payable date in the future. So the marketplace knows that on the day of the ex-dividend date, the stock will be dropped by the amount of the dividend. Therefore, right, puts have to trade at a richer value than the calls because the stock will 100%, no matter what, will get adjusted down by the dividend
Yeah.
amount. Now it could be, up, down, or sideways on the day from then on. But just for that sheer fact of the decline, the market participants know about this. It could be quite tricky if it's a special dividend, for example, that is being declared, right? Or some sort of a, cash spin-off, for example. Those are not projected into the future. They're not known to the market. They're irregular types of dividends. And in those circumstances, calls really get pummeled, right? Like puts should be, worth more in that circumstance to begin with. But if you own a call and you had no idea that a company declares, a special dividend payable at a certain date, guess what? Well, you don't own the stock. You're not eligible for it,
So,
right?
something with those special dividends and spinoffs and such, that's also where you get adjusted options. That if you have a $100 stock that pays a $10 special dividend, well, all of a sudden strikes get adjusted to accommodate for that because it's not priced in like normal expected dividends are priced into securities. So one of the big ways it can impact things is, let's say you're paying a $2 dividend. Everyone knows the stock is going to adjust down on the $2. So if you have an option that should be trading at a $1 premium, and this really happens on something like SPY, where you have an option that's its time premium should be $1, but SPY is going to pay a $1.50 dividend. Well, then artificially the stock is up an extra $1.50. And so intrinsic value for the option is an extra $1.50. So that call is going to be lifted, in essence, an extra 50 cents. That extra 50 cents of intrinsic value over above where its premium should be trading at. Well, and then as soon as the dividend pays, the call loses that intrinsic value. Now it's trading at its proper amount of time premium and it drops. These are situations like this that where you're short an option that there's a high likelihood of being assigned early. And that can then impact things on the option chain, especially deep in the money options.
Nick, what I'm going to do is I'm going to steal the screen here for a brief moment, sir, and I'm going to talk about Starbucks as this example. So, what is one way, and this has to do with the topic that we're discussing. Like, is something liquid? Is it not? It, is the chance or the likelihood of you being assigned early, is it higher than normal? And the way I like to think about this is you hover over the dividend icon and it tells you that it's going ex-dividend on the 16th on Friday and it's going to pay 57 cents per share. So what you automatically want to be thinking is, does my option, does my option's time value have more or less time value than 57 cents? Okay. If the answer is less and the option is in the money, Well, you're at a much higher risk, right, of being assigned early if you're short. If you are long Starbucks stock and you're short a bunch of calls that have gone in the money at this point, what are the chances of the other side, right? The long calls exercising their right early. Why would they do something like that? They would do something like that because they only get paid the dividend if they own the stock. So they're kind of like stealing the dividend away from you, right? So anytime that the time value component is less than the dividend that's about to get paid out, you know that you are in a higher bracket probability of being assigned early on short calls. So that's something to keep in mind. All right, off of this topic here, what else? Let's say, for example, that there is a pretty wide bid offer spread. Okay, so you're saying, okay, Constantine, how about, and John is asking this question, right? What sets the initial bid offer? Is it the Black-Scholes model? Is it the binomial? Is it the trinomial? What sets it? And what sets it is a market maker. Now, the market maker is very likely using a model. And they try to evaluate based on their model. They very likely are using several models, right? And using or coming up with a value of what that option should be worth through the prism of several models. And then based on what it's worth, they wrap the bid offer spread around that value. Okay, so let's talk about how can you utilize Fidelity's tools to maybe play that same role. Hey, I'm feeling like I'm a market maker today. Like 485 calls or 1530 bids, 1680 offer. What is this thing really worth? It last traded at 1530, but that could have been hours ago, right? Could have been minutes, could have been hours, could have been days. I have no idea where this last trade is coming from. So what I do is I'm going to click on this little burger menu here, go to options analytics, and go to the profit and loss calculator. And then what we're going to do is say, well, it's telling me that the midpoint price is 1605. So I'm going to try to mock it up at that value, like 1530 bids, 1680 offer. Midpoint is 1605. It doesn't trade in pennies, clearly, right? So it trades in nickels. So I can either place an order at 16, 1605, 1610. So I'm going to place it at 1605 as a hypothetical transaction. And then what I'm going to do is I'm going to ask the model that Fidelity has, which is the binomial option pricing model, to tell me what the current theoretical price of this option is based on that model's value, right? So this option truly should be worth somewhere around $15.60, but it's 1530 bid, 1680 offered. So if I see something like this, am I going to be very aggressive, right, about trying to buy it at 1605 or higher? No, I'm just going to place my limit order at 1560 and let the market come to me. Now, it doesn't guarantee me a fill, but if it's my prerogative, if it's my decision to trade this particular product, I'm going to try to haggle with these guys and gals, right? To the best of my ability. Now, if you want, obviously, to press, if you want the execution, you're going to have to very likely go up and go up, forcefully, right? Go to the higher bid in order to get filled. But is it going to be the fair price for that particular option? Not necessarily, right? So thinking about that, um, this is a theoretical thing, and theory is only as good as the math that goes into it. So if something has a bid offer spread that you can, fly a jumbo jet through, right? If it has crazy implied volatility in triple digits, imagine that implied volatility wasn't 17 or 18, but it was 170 or 200, right? All of these parameters are mathematical parameters that go into the model And based on those parameters, we try to figure out what the Greeks are. We try to figure out what the fair value for that option is. If the math that we input into the model is garbage, the output is also going to be terrible, right? So the tighter the bid offer spreads, the greater the accuracy of probabilistic outcomes. The better the models work, whether it's binomial or Black-Scholes or whatever else. All right, 10 minutes left here, Nick. I'm going to pop over to fidelity.com and I'm going to show the liquidity screener or share it with everybody. And we'll talk about how we can manipulate. By the way, Schmitty was asking, can we look at NVIDIA? Schmitty, let me tell you something. NVIDIA, we can certainly look at it. NVIDIA right now today, and it has been for months, is the most liquid single stock options that exists. Kind of dethroned Tesla. Tesla was the king or the queen, if you will, for years. But NVIDIA, with what it has done over the past couple of years, has dethroned it. So NVIDIA, on the regular day, and I've been doing this a long time, shooting off the hip here, probably trades 3.5 million contracts a day, right? I wouldn't be surprised if it's done substantially more than that already by 320 right now, right? So it trades, it's about as liquid as it gets. We talked about SPY being the most liquid exchange traded product options. NVIDIA is, the SPY of single stocks, if you will. Okay, so there's no need to be worried about liquidity in that one. That's about as good as it gets. I'm going to go to and walk you through this process. Okay, so before I do that, I have to relog in. So give me one brief moment here. This happens sometimes, right? When we get timed out. So back to Active Trader Pro,
As
just to show you what NVIDIA is doing, and I'm going to log in here for a brief moment.
as Constantine pulls that up, one of the defaults that will pop up when you're screening is, in essence, it's a high options volume screen. And it can be really interesting to then look for ideas. One of the big things I want to point out that you'll see as soon as Constantine then pulls that up is that the screen looks for a minimum option volume of 200 contracts. And this gets into what I was saying earlier about looking at that minimum 5,000 or 20,000 contracts. That if you have a security that's doing 500 times its average, well, 500 times an average of 200 contracts, only had 1,000 contracts today. That can be a small trader, throwing out there a penny order, or a 1,000 times the average. And so, therefore, you can screen through and you only look at securities that average 5,000 or 20,000 contracts at once. Well, then you'll start to see something that might mean more to you, with actually seeing a 500% over average option volume, but having, like we see a 23,000 on average that had 135,000. That's actually a lot above average compared to having an extra 100 or 200 contracts.
Yeah, Nick,
But Constantine, you have it pulled
I
up.
certainly
Let's
do.
go
There's
ahead.
some remnants, right, of potential escalation between Iran and Israel that have been reported, not necessarily confirmed, right, um, by official forces anywhere, but you can see that the market is reacting to it, whether it's in the volatility space, it's VIX tails or S&P 500 tail puts or oil WTI futures, or of course USO, which is a proxy, right, on WTI futures contracts, the curve across the board. So there's clearly something going on. Like people are maybe anticipating and preparing for something like that to happen in the very, very near future, 24, 48 hours or whatever it might be. So yeah, Nick, I would agree with you. I mean, you see something like USO doing 136,000 contracts, which is more than 6x its average. That's a pretty big deal, right? Like there's no doubt there's some action there. But let me talk to you folks about the custom scans. The way you would go about, of course, creating the custom scan, and you would come to this place to explore the pre-built ones. That's totally fine, just fine. but you want to create a brand new one. So hitting create new. And when you do hit create new, what you will be seeing is something like this, the create criteria for the new scan on the left-hand side. And if you expand out all of these fields, you would notice that there are hundreds of criteria to choose from.
A lot.
So Nick, in order not to, this could be quite complicated, right? In order to kind of structure at least a skeleton for everybody, I'm going to go through some criteria and the reasons why I've chosen them. And then you can make it more robust. You can
Last gym with our audience.
Yeah, by the way, folks, since Nvidia is on the board, right? I mean, market cap wise, it's substantially smaller now than Apple. I don't know how long that's going to be the case, right? Or for how long. But look at the volume here. When I was talking about how it's the most liquid security on the board right now, I mean by several fold, right? I mean, it traded 329 million shares today and almost 3.9 million contracts. And Apple traded less than a million, right? So it's an incredible security with massive amounts of participation, just about as crazy liquid as it gets. Anonymous was saying, can you show again the filters tool or how to get there? Sure, I could. You go to news and research, you go to options from the drop down. Now, this is where it's going to depend on what sort of an account you have, whether you've been upgraded to the new version or not. Okay, very likely that most of you are going to be faced with the new display. And we'll let the test account here load up for me in a few seconds. Hopefully it will. Let's do this again. News and research options. And we should be greeted by an options chain. See if it really loads up for me here. Give it a few seconds. Okay, you're very likely going to be greeted by something like this. Now, there are a few ways to get there. You either are going to go back to your classic view, which is the quicker way. But the problem with that, if you get used to it, right? We know that that button is going to be going away at some point. So the preferred version would be type in a security, any security, into the quote or get quote or symbol or get a quote. Pull up the option chain, and then know that the burger menu or the menu buttons here, the dots, are the ones that are still active, right? On either the puts or calls. So you would go to these buttons here and you would go to trading ideas. And that takes you to the screener. Now, what I would do if you wanted to avoid, these extra steps every single time, just bookmark this
Bookmark it.
page, right? So you come directly to it, and then the scanners that you've created are going to be there. You can edit them. You can, create new ones and look through all of the pre-built stuff that's already out there. Okay, so hopefully that helps. Dennis was asking, can you comment on bulls versus bears, understanding the market structure? It has no description. What will be covered? Well, Dennis, Nick and I are actually going to be in that particular class. And I think, there's no description, there's no structure to this because it's a brand new session. And we're going to be approaching it from, well, at least I can speak for myself, right? The way I'm going to be approaching it, the way I'm collecting my thoughts for that particular session is really trying to explain to you how you can, as a retail trader, how can you determine who is in control? How to determine, is it the supply driven action and supply or sellers are aggressive and are overwhelming demand, or the other way around? That's all that it truly is about, right? Bulls versus bears. Like, when do you want to be bullish? When is the preponderance of evidence showing you that it makes sense to be bullish or makes sense to be bearish.
Yeah.
That's the thought process, Dennis. So looking at all sorts of things, right? Looking at historical volatility, realized volatility, implied volatility, looking at the bid offer spreads, looking at the patterns and market structure from the technical standpoint of view, X, Y, and Z, short interest evaluation, volume, right? From the anchored volume weighted average price perspective, from volume shelf perspective, basically everything that you could do to kind of give yourself a good enough fundamental base to make a decision. And from there, of course, realizing that you could always be wrong, therefore evaluating that position size for risk, right? So Dennis, that's the idea. That's what I will be talking about. Nick, how about you?
A lot of the very similar things, though adding in there some broader market indicators, such that, looking at, advancing, declining from that particular perspective. We have some other classes that we bring some of that in to also look at, what is going on in general versus specific to a particular security. But my mind was right where you were at as well, Constantine.
Very good. Nick, GL was asking a question about whether Fidelity, could Fidelity create a tool that would just show I mean, wouldn't that be fantastic, right, GL? Like if I was an app developer or a tool developer, I would definitely do exactly that. Yeah, the securities that I own, do they have, a good options liquidity meter or a bad, right? And what determines that? Unfortunately, I'm not a web page developer, right? So all I can do is supply my feedback to them until I'm blue in the face. And I do that, believe it or not, a lot. Um, my voice, however, is just one voice. So your voice matters. If that sort of thing matters to you, you have to tell the developers that you care about it. Believe me, they care about your voice a lot more than they do about mine. What I would also like to point out to GL is that if you utilize, there's a free trial, and you know that we're never on the strategy desk, right, trying to sell you anything at all. But there is the options play tools that are being developed. They can be found under options play strategies. This tool specifically will evaluate your portfolio for opportunities. It will tell you what the liquidity is, how tight the bid offer spreads are for the underlying, how many options have traded on the security. It's not necessarily like exactly, GL, what you were looking for. Is liquidity good or is it bad or is it middle of the road? Like it would be great if there was a 5-star rating system of sorts. Hey, we would prefer to see the 4s or 5s. But if it's 3, it's probably still okay. If it's 1 or 2, it's not for me. That would be a wonderful tool. That's a great idea, and I wish we had it, but we don't. Let's see, what else can we answer?
Constantine, can you pull
Stuart,
back?
thank you.
Oh,
Thank you for standing up for me. Stuart's telling them that he did tell them not to take away our terminals. Nick, I want to say I appreciate it. I'm certainly going to miss it. Hopefully we'll get them back, depending on how effective we are, I guess, at making that case to our uppers. Nick, last words to you, sir, as we wrap up here.
I was going to ask for a quick wrap up. Can you pull back up the screener that you pre-built everyone, so everyone can take one last screenshot of that? Those that weren't able to, we had a couple questions that were asked on that, and did have somebody asked. Of course, Dennis mentioned looking forward to that session. Constantine and I will also be back again for the morning market brief again tomorrow morning. And we do have the after market session with Robert and Troy taking off in about 20 minutes for those that do want to take a look at kind of where the market wrapped up. But Constantine has that pulled up now, showing everyone what he used for the screener. So please take your screenshots of this now to save that wonderful information.
And right, I mean, you're not going to break it, so open up the fields and kind of think through this stuff. And if you have questions, particular field doesn't make a whole lot of sense, come back, let me know. I'll be glad to answer any of the questions. I mean, I'm probably one of the most frequent users of this particular tool. I try to use it every day, sometimes dozens of times a day, with hopes that it's not going to be going away or it won't get decommissioned because there's somebody using it actively. But the more people are going to use it actively, right, the greater the case for it, or at least they'll try to rebuild it, right, with a new view or something like that. But that's my thought. Take care, everybody. We appreciate you very much. Thank you for supporting us, Nick. It was a pleasure. I'll see you in the aftermarket briefing. Troy and Robert in that one. Take care.
Take care.